and welcome to another edition of GTP TV. My name is Tracy Richardson and I'm here today to present to you on the subject of returns on investments, or more particularly term deposits versus blue chip shares. A common question asked by people is, what should I be doing with my money to get the best return on my investment? So today I thought I would run through 3 different investment options, comparing the different returns on each of those, as well as the associated tax implications. And then most importantly, looking at the after-tax returns on those investments, demonstrating that the returns may not be what you initially thought they would be after tax. So for the purposes of my calculations today, I'm basing it on that a principal sum of $10,000 is to be invested by an individual earning less than $37,000 per annum and on a marginal tax rate of 21 cents in the dollar. The first option that people typically look at is a term deposit. Now, term deposits are very safe investments, and for that reason they do tend to yield the lowest returns out of the 3 options that we are looking at today. Currently at the moment, the best rates that the banks are offering are 3 to 4%. So for our calculations today, we'll assume that our individual can get that higher rate of 4% interest. So if we apply that to our $10,000 initial investment, that would yield the individual $400 interest income, but then of course they do need to pay tax on that $400 at their marginal tax rate of 21 cents, which equates to $84. So once we deduct that $84 from the $400, their final yield on their $10,000 investment equates to $316, or as a percentage, 3.16. Not quite that 4% that they initially thought they would be getting. A slightly riskier option that the individual may then want to look into is a blue chip bundle of shares. Now, blue chip shares typically do have a very good reputation for trading profitably in good times and bad, and paying stable and rising dividends. So they should be a relatively safe investment. The term blue chip is actually thought to have come from the game of poker, where blue chips are typically the most expensive chips to buy. Likewise, our blue chip shares do tend to trade on the high end of the stock exchange. So for the purposes of our calculations today, we're assuming that the dividends are yielding 3.9%. So if we apply that to our $10,000 investment, we're getting a $390 dividend. Now, because the dividend is fully franked, it means that the company has actually already withheld tax at their company tax rate on that dividend at 30%, which equates to $167. So when we actually disclose our dividend in our tax return, we need to gross our dividend back up to the amount before the tax was withheld, which equates to $557. I liken this to a wage earner. Even though they're receiving a net amount, when they disclose their wage in their tax return, they need to gross it up to that gross amount. Now, the beauty of this type of investment is that our individual is only having to pay tax on this investment at their marginal tax rate of 21 cents in the dollar, which is obviously 9 cents less than the 30% company tax rate. So it equates to them paying $117 tax, but the company tax has already paid on their behalf equates to $167, which makes them eligible for a tax refund of $50. So if we take that $50 refund and add it back onto the initial investment, the individual actually ends up with a $440 yield on their $10,000 investment. $124 better off than they were underneath a term deposit. A third option that an individual may want to look at is also another bundle of blue chip shares, but unlike the second option that we had here, this bundle has a very good reputation for paying high yielding dividends, but doesn't have the premium built into its share price. So its share price can be a little bit more volatile than what the second option was, therefore making it the riskier investment. So again, if we crunch the numbers, the 5.3% fully franked dividend makes our individual entitled to a $530 dividend. When we crunch through the numbers, tax payable by the individual is $159, but again the tax paid at the company tax rate is $227, giving our individual a tax refund of $68. Again, when we apply that to our initial investment, our individual ends up with a total yield on their initial investment of $598, or as a percentage, 5.98%. So as you can see, the riskier that our investments have got, the greater yield returns we've also received. What I would really like to emphasise to you today is that these calculations are based all on this individual's unique circumstances. So you need to be wary of, when you're planning your investing, your circumstances may be very different to this. So you need to seek further advice. So please feel free to contact me, Tracy Richardson at Green Taylor Partners, on 53824761, or alternatively you can access our website at www.greentaylor.com.au, or access us on facebook.com/Green Taylor Partners, or even join our mailing list on www.greentaylor.com.au. Happy investing!